Look at the latest news on Lam Research Corporation, ticker symbol LRCX. I mean, you see the chart, you see this massive upward momentum, and you really have to ask yourself a high-stakes question.
Right. It's the big debate, right?
Exactly. Is this stock an undervalued darling, just, riding the massive AI wave? Or are the flashing sell signals buried in the data telling us it's a high-priced value trap? Like a trap ready to catch unsuspecting retail investors.
It really is the ultimate market Rorschach test today. I mean, depending entirely on your timeline and which metrics you prioritize, you either see a brilliant generational opportunity or, well, a catastrophic cliff.
Which is exactly why we are pulling it all apart today. So, welcome to the deep dive. Our mission today is to completely unpack a massive stack of financial sources, technical analyses, and some seriously heated bull versus bear arguments regarding LRCX.
And we're looking at all of this as of today, April 13th, 2026.
Yes, April 13th. And before we get going, please take a second to like the video and subscribe to our YouTube channel. And it is compulsory that you leave a comment with your feedback on whatever platform you're listening on to help fuel the algorithm.
Definitely do that. But we also need to explicitly state that this deep dive is strictly an educational exploration of the provided data. We're looking at the math, the market psychology, but this is absolutely not financial advice.
Right. Always do your own research.
Exactly. So setting the stage, LRCX has outperformed something like 97% of the broader market over the past year. But, past performance isn't the whole story, so we really need to peel back the layers, starting with the raw numbers.
So let's jump straight into that bedrock, the financial foundation.
Yeah.
Because the journey this stock has taken over the past year is just, well, it's jarring.
It's been a wild ride.
It really has. I mean, the current trading price is hovering around $263.66. It's up about 1.89% just today, sitting right near its all-time high of $263.23. But the 52-week range blew my mind.
Oh, yeah. Where did it start the year?
It climbed from $61.14 all the way up to that $268 level. That represents a 54% year-to-date gain.
A 54% gain. I mean, when you see a chart that goes up and to the right that aggressively, you have to immediately strip away the hype. You have to ask what the fundamental business is doing to actually justify that trajectory.
Right, because momentum without an engine eventually collapses.
Precisely. But looking at the income statement, the engine looks pretty massive. Over the trailing 12 months, they pulled in $20.56 billion in revenue.
Wow.
Yeah, and $6.21 billion of that was pure net income. That gives them a profit margin of 30.22%.
30%, that's incredible.
It is, and they are earning an EPS of $4.88. The operational efficiency to maintain a 30% profit margin in this specific sector is staggering. Because Lam Research, they build the machines that build the chips, right?
Heavy industry stuff.
Exactly. Manufacturing semiconductor fabrication equipment requires immense capital expenditure, highly specialized R&D, and brutal supply chain management. So keeping 30 cents on every dollar as pure profit is just wildly impressive.
Well, and I was looking at their balance sheet, and it really looks like a highly responsible household paying off a mortgage. I mean, they are sitting on $6.18 billion in cash right now versus $4.48 billion in total debt.
That's a great ratio.
Yeah, over the last 5 years, they've actually slashed their debt-to-equity ratio from 105% down to just 44.2%. Their operating cash flow covers almost 160% of their debt. They're practically swimming in cash, so why is anyone bearish?
Well, the liquidity is undeniably excellent. It's a fortress balance sheet. But that brings us to the first kernel of doubt, right? High profitability often leads to a premium valuation.
Meaning the market already knows about the cash.
Exactly. The market might have already priced in all this good news. When you are priced for absolute perfection, any slight macroeconomic hiccup can trigger a violent sell-off because that premium valuation just isn't justified anymore.
So if the financials are a fortress, how is the market actually reacting in real time? Let's pivot from the historical financials to the current technical momentum and the order flow.
This is where the story gets really interesting.
Right, because on the surface, the trend direction is highly bullish. It's comfortably sitting above its 50-day moving average of $228.07, and it's miles above the 200-day moving average of $161.72.
And it has some pretty firm floors, right? Support levels are looking solid at $245 and $235, with primary resistance right up at that all-time high of $268.23.
But the momentum indicators are starting to whisper something else. The RSI is currently at 66.93.
Yeah, that's neutral to bullish, but it's creeping dangerously close to being overbought.
And the MACD is flashing some severely mixed signals. Some technical analysts see a negative 1.33, which is a short-term sell signal, while others see a 6.05 breakout as it tests new highs.
The charts are conflicted, but the real mystery here is the order flow. We have institutional whales, the massive funds, actively buying and sustaining this upward pressure.
Right, the big money is buying.
But when you look at the corporate insiders at Lam Research, over the last 6 months, insiders have sold 396,794 shares.
Almost 400,000 shares dumped.
Yes. And you know how many shares insiders have bought in that exact same time frame? Zero.
Zero. Not a single share. I mean, look, if the food at the restaurant is so amazing, why are the head chefs sneaking out the back door?
That's a great analogy.
Is this insider selling the ultimate warning sign for short-term weakness? Because that feels like a red flag.
Well, you have to add some nuance here. Insiders often just cash out at peak levels for personal reasons, right? Taxes, buying houses, standard executive compensation stuff.
Sure. That makes sense.
But the warning is that when whales are aggressively buying the COP and insiders are quietly distributing almost 500,000 shares into that buying pressure, you get extreme volatility. And that volatility is exactly where retail traders often get trapped.
Right, because the retail trader sees the stock hitting all-time highs, they read the headlines about funds buying, and they jump in right at the absolute top.
Exactly. Just as the insiders finish unloading their bags. If the stock drops, the retail investors are the ones left holding the bag at a massive loss.
That dynamic, the whales buying while insiders are cashing out, perfectly mirrors this massive divide among financial analysts right now. Let's get into the valuation clash. Is this stock undervalued or a value trap?
The spread between the price targets right now is just wild.
It really is. The general consensus across 26 major analysts sits at a buy or moderate buy, with an average target of $279.13. But then you have firms like Susquehanna coming out with a sky-high target of $350.
That's a very optimistic bull case.
But then you look at the bearish side, the trap argument. Mathematical models like the Guru-focused DCF ran the cash flow numbers and slapped a fair value of just $153 on the stock.
Wow, $153? That's a massive drop from the current price.
Yeah, they're calling it significantly overvalued. And their main argument hinges on the trailing PE ratio, which is sitting at a massive 54.04.
Right. Paying $54 for every $1 of earnings the company actually proved it could generate over the past year is an incredibly steep premium.
It really is.
Yeah.
But the bulls completely ignored that trailing PE. They point instead to a forward PE of $38.76. And they justify that with a massive projected 27.5% EPS growth in fiscal year 2026.
Which is a huge assumption.
Right. I'm baffled by the gap. We have one model saying it's worth $153 and a major firm saying $350. How can the so-called smart money look at the exact same data and disagree by $200?
Because it's all about market psychology. They aren't arguing about the math, they're arguing about time horizons. The bears are punishing the stock for what it costs today, relying on the trailing PE. They want proven reality.
And the bulls.
The bulls are willingly paying a premium for the promise of tomorrow. That forward PE of 38 is entirely reliant on the future materializing perfectly.
So to figure out whether that promise of tomorrow will actually materialize, we have to step away from the charts and the models. Let's look at the real-world macroeconomic catalysts and risks.
Let's do it. What's driving the bull case on the ground?
Well, the single biggest driver is the surging AI infrastructure demand. Specifically, we're talking about demand for HBM4 and DRAM equipment. And Lam Research has actually expanded their market share in wafer fab equipment to 15%.
Capturing a 15% market share in wafer fab equipment is notoriously difficult. The barriers to entry are just astronomical.
Right. It's not like starting a software company.
Not at all. So capturing that share means billions in locked-in recurring revenue for maintaining and upgrading those machines.
There are also some geopolitical sentiment boosts. For example, the news of a potential Iran ceasefire. And look, purely from a market sentiment perspective, regardless of politics, a cooling of global tensions usually drops risk premiums.
Exactly. When the geopolitical landscape feels more stable, tech giants and foundries are much more willing to sign multi-billion-dollar contracts for new equipment.
But the downside risks are where I really start to worry about that 27.5% growth projection. The bear case is pretty stark. First, their revenue from China is falling, expected to drop below 30%.
That's a significant chunk of revenue at risk.
Yeah, and second, there are major CapEx spending cuts coming from giants like Intel and Samsung. And third, there are these clean room bottlenecks that are delaying equipment orders.
Those CapEx cuts are a huge red flag. Lam Research doesn't make the chips, right? They make the machines that make the chips. Intel and Samsung are their primary customers.
Right. So if I'm a listener holding this sock, and I read that Intel and Samsung are suddenly tightening their belts, how quickly does that ripple down to Lam Research?
It hits them almost immediately. If Intel delays a factory expansion, the demand for Lam's multi-million-dollar machines dries up instantly. They won't order the machines until the facility is ready.
Which leads right into the clean room bottleneck issue. I mean, the demand for AI tech definitely exists, but if the physical infrastructure to build it is delayed, revenue is delayed.
Exactly. The nature of these capacity constraints is brutal. Building advanced AI chips requires perfectly controlled clean rooms. We're talking virtually zero airborne particles, perfect humidity, and extreme vibration isolation.
Wait, vibration isolation, like to stop the machines from shaking?
Yes. The machinery operates at the nanometer scale. If a heavy truck drives by outside and the floor vibrates even a fraction of a millimeter, an entire batch of AI chips can be ruined.
Oh, wow. I had no idea it was that sensitive.
Yeah, it's insane. Building these clean rooms takes years and requires highly specialized contractors. And there is a massive global shortage of those contractors right now.
So even if the tech companies are screaming for more AI chips, if the factories aren't finished, Lam can't deliver the machines.
And if Lam can't deliver the machines, their revenue gets delayed. And if that happens, the stock's short-term momentum will crack.
Bringing it all together, we've covered a ton of ground today. You have a fortress balance sheet offering downside protection, but you also have a massive clash between the unstoppable AI software demand and the physical bottlenecks of clean room construction.
Yeah, the long-term perspective hinges entirely on whether AI infrastructure demand can outpace these capex cuts and geographical risks.
But the short-term outlook is highly volatile. Because we aren't just waiting around, right? The entire market is holding its breath for the upcoming April 22, 2026 earnings report.
That report is going to be the ultimate reality check.
Well, thank you for joining us on this deep dive. Hopefully the mechanics of LRCX are a bit clearer for you now.
Yeah, and I want to leave you with a final, somewhat provocative thought to mull over. With whales buying the AI dream and insiders quietly selling their shares, if that April 22nd earnings report reveals even a slight delay in AI revenue due to those clean room bottlenecks, who will be the first to panic and sell?
And more importantly, will the retail investors be the ones left holding the bag? Keep your eyes on the data, and we'll see you next time.